We are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that I love to call GC because he's got these genius concepts, because he knows how to generate cash flows, and because he's a great co-host, and his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
Great to be with you, GC, and great to be with our magnificent community manager. Always helpful in the chat. Anything you need, if you're new, make sure you reach out to her, Madison the Magnificent. Say hello, Madison.
Hello, everybody.
Good to have you, Madison. And it is great to see the chat lining up, as is tradition around here, because we got a great community. So if you are listening on the podcast, if you're watching on Facebook, my number one piece of advice is to go to nyais.com. That's not your average investor show.com, nyais.com. Put it on your calendar. Show up one of these days when you don't have a lunch date or something like that, and just, opt in, make a friend in the chat. And, maybe one day you'll get to be part of, what is it, GC? What's coming up?
The roll call.
The roll call, everybody. We got our leadoff hitter, John Henning, kicking this off, saying good afternoon all. We got Melvin Douglas. Is that a new name?
It's a new name to the show, but I know Melvin, and he has been a longtime client. We are super excited to have Melvin on the show.
Super excited to have you, Melvin, longtime client, fellow client like myself. I would love to hear what made you want to show up, Melvin. Let me know in the chat. We got Dean Curry checking in, our immediate past guest investor star of the show from Columbus, Ohio, who brought straight fire. We got Lee Bishop, the MVP of the Not Your Average Investor Show community. We got Nadeem Shah checking in. Good morning, good afternoon from the West Coast with his trademark. We got Madison hitting, what is it? What is it after cleanup? What's the fifth hitter? Well, I forgot about that. It's like something else. Madison's checking in here in the chat. Raj Banthu's back. Good to have you, Raj. We got Drew Barnhill, the ringmaster of the Not Your Average Investor Show community, checking in. He's been all for duh. We got Mark McDermott is back. Good to have you, Mark, back in the house. We got the name everybody knows, Noah Randari. He says hello, everyone. Greeting from California. We got Denny Davis checking in from Germany. Guten Tag, part 4. Wouldn't have missed any of them. We wouldn't have done it without you, Denny. Sort of. All right, we got who else? We got Aaron O'Neill checking in. Aaron, out of the shadows and into the lights. Aaron, we love to have you checking in here in the chat. Love saying your name. We got the matriarch and the patriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Moline. We salute you.
Tip of the hat.
Oh, God, you always get that wrong. All right, we got Tony D in the house. He says, greetings all. Anthony Dida from Jupiter. I'm already starting to sweat out here, GC. This is hotter than the studio where I'm at right now.
Bringing the fire, baby.
bringing up my little Schwetzen over here. All right, we got Curtis Hailstock saying, hey all. Is Curtis a new name?
Name?
New name?
Is that a new name? Is that a new name?
Curtis, welcome to the show. Love having you. Checking in. Let Madison know what brought you. We want to give you a proper welcome, buddy. Good to have you here in the house. Pablo is not still in Cleveland. Pablo is right now in North Carolina. I'm gonna be here for 2 weeks, so you're gonna see me schwetzing over here for the next couple of weeks as we do the show. John Hanning checking in with a Q&A saying, online article listing Jacksonville as one of 40 cities poised for housing crisis. Your thoughts, GC?
Oh, geez. What article do we want to pull today talking about this impending housing crash? Sure, let's throw Jacksonville in there. We got to go to the data, guys. We got to go to the data. We just actually did a team meeting for our Jacksonville market update for our team. And, the data is just very different than what the headlines read. When you're talking about housing crashes, you usually would want to, maybe have some data about house prices going down, or maybe you have some data about inventory levels rising, which might indicate that housing prices are going down. And when you look at the actual data, home prices are still going up. And inventory levels, while they are rising, are still so low. Actually, fresh update here. The months of inventory number here in Jacksonville is 2.
Breaking news. Greg has a new update. Go ahead, Greg.
There you go. The months of inventory number is 2.3 months of inventory for any of our longtime listeners. When you have a months of inventory number that's less than 6, that's an indication that home prices would go up in the short run at a rate that's faster than the historical average. The historical average in Jacksonville is 4.5%. So I'm not saying that home prices are going to be on fire. I'm telling you that home prices are going to level off. They have to, because we've been seeing 15 to 25% appreciation year over year over year for the last 3 years. But guys, inventory levels are still so low. It's okay that inventory is rising a little bit. There's not an impending crash.
All right. And uncommonly early teaser. Next week is the fan favorite Q3 market update. Is it not, GC?
You are so excited for it, but we have that on the 15th and the 16th. So we've got
I was way off.
Our buddy coming in for creative strategies next week. So, we're all excited for all of those episodes coming up.
I just can't contain myself. All right, GC. Well, then I'm going to stop speaking out of order. Let's get back into order. We are on the epic part 4 mini series finale of the first ever mini series of the Not Your Average Investor Show. This is history, folks, but let's catch folks up. If you haven't been here for parts 1 through 4, you missed a bunch of detail, but we're going to catch you up kind of like HBO does the in case you missed it. So we started the first one, right? We started talking about how to invest before a recession, because as we all know, there is a recession looming. And as we all know now, JWB was started in 2006. Your boy, GC, with the genius concepts, he decided to start investing in real estate at the worst time possible to ever invest in real estate in many a generation. So why don't you catch us up? Part 1 was 2006 to 2010. GC, what do we need to know about that?
Yeah, so 2006, I was 23 years old and was riding high on a dream and a hope and a prayer to leave the corporate world and start a real estate investment company with my best friend. And we had no clue what we were doing, but we just loved the thrill and of the idea of starting a new business. And, luckily we had surrounded ourselves with people that were a lot smarter and a lot more successful than we were specifically in rental property investing and building a business. And so we learned from some great mentors early on. But in the beginning, we tried a lot of different things in real estate, like most fledgling businesses do in the beginning. It was all about survival. And we tried flipping properties. We tried flipping high-end homes. We tried a strategy called wholesaling, which is basically finding undervalued properties and flipping them to other investors. And we tried a lot of different things. Luckily, one of the things we learned very early on is the value of buying rental properties as early as possible. Rental properties like a fine wine. They get better with time. And if you've got time on your side, if you invest in those early, they pay off more and more and more the longer you hold on. So from 2006 to 2010, while we were building our real estate business, we were building the foundation of our rental property portfolio. And, a couple 23, 24, 25-year-old kids, we were able to build a rental property portfolio of 40 properties in the first few years. And that, of course, we still own those properties today. That was the foundation of not just our rental property portfolio, our retirement account is how we thought about it, that we would access in 10 years or 20 years from that point. But that, of course, became the foundation of the vertically integrated experience that we know and love and sell today, which is the JWB experience of buying turnkey rental properties.
What I remember from those calls, GC, is this idea that you tried all these different things and the world, you had just gotten into real estate, right? So like the world around you was melting and you were kind of looking around and thinking, yeah, all this other stuff is broken, but these 40 over here, like everybody's telling me that I should be really worried about home prices crashing, but feeling pretty good. Can you tell me a little bit more about that?
Yeah, I felt like I was living in an alternative universe at points because while I'm sharing with you how well these rental properties did, even in the Great Recession, right? Rents were still strong, right? Properties were occupied, all of those good things. It was consistent, all of that. The other part of this was that I was like 2 years into being a business owner and I was also trying to flip real estate. And those days were not going so well, right? We took massive losses on all of our projects where we had to flip houses as the Great Recession happened. And so, on one part, I learned from that about all the things that we were doing. What were the things that were being most profitable and also taking the least amount of my time? Flipping houses were taking all my time and I was losing a ton of money. Rental properties, I wasn't spending any time with and they were just consistently producing cash flow. They were consistently producing 5 profit centers for me. You know, the one profit center they didn't produce at that time, which was short-lived, was home price appreciation. Home prices went down. But again, what we preach on this show and what our successful clients employ is a buy and hold strategy for a full market cycle. So I wasn't anywhere close to a full market cycle. I wasn't anywhere close to needing to tap into that equity. And so it didn't affect me on a daily basis. And so the alternative universe I felt like I was living in is everybody else in the world told me that I should run away from real estate. I should run away from rental properties. Oh, I'm so sorry that you bought these 40 rental properties. I would get this wherever I went. And I was like, no, those 40 rental properties, I'm pretty happy with. I've got inexpensive debt on those. They produce positive cash flow. I was like, I mean, I would wonder, I wouldn't say this, but I'm like, how's your stock portfolio looking right now? Like, I mean, should I be saying I'm sorry for you? No, like rental properties still performed even in the Great Recession, as long as you buy and hold for a full market cycle. And so my quality of life only got better from my rental property portfolio as the rest of the real estate world and the rest of the world was really in a tough spot. So that was the alternative universe I was living in. I looked at the books and I looked at my rental properties. And I was like, okay, well, everybody else was telling me that I should somehow feel bad about it.
Okay. So you guys are at that 40, you're at that 40 mark, first 4 years, next 4 years. What was that all about, GC? What was part 2 about?
So if I go from 2010 to about 2014, let's kind of go, let's talk about where our headspace was at that point, right? We were a fledgling business. We were just punched in the gut to the degree that we never expected. And most businesses absolutely went out of business, especially in real estate from 2006 to 2010, people were running away. We doubled down on our systems. We doubled down on our technology. We doubled down on our people, investment in people. We hired more people. We bought more properties. And we started to really refine this vertically integrated approach to investing in real estate. And we realized that that is where we're planting our flag. Like that's what we're made of. That's that intersection of what we can be great at and what comes natural to us. And so, from that point, 2010, if I go to 2014, that was a special time of business building mode. We were starting to have our first years where we would sell more than 100 turnkey properties. Our team grew from probably 15 people to maybe 30 people, maybe 40 people. And we were really starting to crush it, especially in 2011, I think we sold 65 properties. And then 2012, we sold 175 properties. And for a young business to triple your sales and maintain margins in a 1-year period, it wasn't just about, creating more capital for the business. It was like, there was an emotional component for all of us. We were like, we nailed it. Like we stuck through this, we stuck through the hard times, and we are better positioned than our competition to create this value through this experience. So 2010 to 2014 was all about refinement, all about client experience, all about building the business. We had already put 40 rental properties in my business partners and I, in our in our retirement accounts, right? That's basically 10 properties per person. We were like, okay, cool. That's good. Let's keep having that mature, keep having those 5 profit centers. And so we did not buy and add more properties to our rental property portfolio from 2010 or 2014, or it wasn't a significant number. The real significant growth came 2014 and on.
Yeah. Yeah. And when I think about that chapter in the story, I think of like the throes of entrepreneurship, right? Like you basically found the product market fit. You found something that had worked for you. And then you're like, oh man, so this can work for other people. So you started offering it. And then when I think about it, I think that, or at least I tell myself, right? Like these 40 rental properties gave you the confidence to think more long-term than others. When other people were not hiring, when other people were kind of running away from it, you decided to build a team and build infrastructure because you had learned this like long-term mentality and you had received positive signals out of it. Is that kind of true?
100%. I mean, if you think about it, we were in a tough spot like every other business in 2008, 2009, 2010. I mean, we took on massive debt from a business perspective to be able to weather the storm, right? all along the way, everybody is chirping in our ear that you should just tuck and run. You should get out. You should get out. You should get out. You know, the proof of how rental properties performed for us gave us the confidence to say, I'm not going to listen to this noise. Not only do I have something that's going to keep me in the game here, but I have something that is so special. If we can just figure out how to refine this, I can bring this to the world. I can bring this to the market. And this thing works. And so we put all of our eggs in the basket of turnkey rental property investing because it proved to us that it worked. But I'm not going to lie, like that was a big bet to make, right? Like we had a lot. I mean, I didn't really have much money at that time, to be quite honest, but like, it wasn't just about the money that I was risking. Like I was borrowing money from friends, families, my family, people that I knew very well. And I was so confident in real estate and rental properties being that bet to make that I was willing to take that bet because I understand these 5 profit centers. And I understood that the only reason that I couldn't bring it to the masses was experience. If I could just figure out this experience thing for rental property investing, more people would put it in their portfolio. And you know, that's what's proven to happen.
Yeah, man. So next chapter, you went from build a team, invest in infrastructure, go for experience. The next 4 years was really when you realized that the key to the experience was getting really awesome at property management. You want to tell us kind of like what the lessons were learned in that period and what that journey was like real quick?
Yeah. And for anybody who didn't tune into the first few shows, you know, what I shared with you is that in the very beginning of our journey here, we did not envision ourselves as being a property management company because property management's hard, right? Most investors, most real estate people, guys and girls go into real estate and they want to be deal makers. They want to acquire, right? That's the sexy part of real estate, right? I want to build my army of income producing assets. There's not very many real estate investors, or at least there weren't back in the day, that said, I want to be the best darn property management company. And that wasn't us as well in 2006 or 2007, 2008. But it was around 2010. You know, at that point, we had these 40 rental properties, and we actually outsourced that. We went to the best property management company we could find here in Jacksonville. We gave them our 40 rental properties. And these are properties that we were already managing before, so we knew how to do it, but we wanted to get a better value for our time. And we said, let's go and find somebody else. It's the best that we could find. Interviewed everybody. And we learned very quickly that they could not perform the way that we needed our assets to perform. And it became very clear to us, there weren't long-term leases being signed. There wasn't a focus on renewing leases. Rental rates weren't going up like they should have, like they were before. Rental rates weren't going up like they should. And then we looked at this and we said, okay, if we believe that rental property investing can work for folks, but we don't have the best property management, none of this is going to work. It was that critical. And that mindset shift allowed us to say, okay, wow, we need to look at property management not as this thing that we didn't want to do. Our whole business really depends on becoming excellent at property management. That's a key differentiator for us. And so we changed. We went to one conference. We met with a very close friend who runs a property management company. He shared his perspective. We also looked at like the business benefits of having recurring income coming in from thousands of clients and, you know, small amounts every single month, but coming in from thousands of clients and thinking about what that could do for our business and the security that could bring in all market cycles. And we said, okay, wow, let's rethink this. Let's rethink this. And yeah. And so 2010 is when we started our own property management company, JWB Property Management. And from that moment, we have, you know, property management has been the bedrock of this client experience for us. And yeah, from then on, it's been, how do we refine? How do we tweak? How do we make this better and better and better? And property management is the key.
Yeah. And you mentioned kind of 3 indicators right there. That was what pinged to you after having done it, which was they weren't signing long leases, they weren't renewing residents, and they weren't getting increases. You want to tell me why that's important as far as the experience goes?
Well, yeah. Number one, the biggest pain point for you as a rental property investor comes down to maintenance cost and vacancy cost. And if you go one step farther, the biggest reason that you have maintenance costs and vacancy costs is because residents leave early and often. And if you think, why do they leave early and often? Why is there so much turnover? Why do you hear that from your friends telling you, oh, I never want to be a landlord because my resident leaves or all this? It's because you only ask them to stay for a year. You only have them sign a 1-year lease. This is the way normal property management works. Well, as we were rethinking this, and as owners of rental properties ourselves, we started to think about this, and we said, the way to win in owning rental properties is having residents stay long-term. If you have a resident stay long-term, that extra cost of maintenance costs to put the property back into great renting shape, or the couple months of vacancy costs that you have don't happen, or the extra property management fees that you incur from putting a new resident in place, they don't happen every year. They don't happen every 2 years. And if we could really put long-term leases together, if we could ask people to sign long-term leases and get them to buy into that, and then we could focus our property management team on renewing those leases at a really high rate, well, we could extend our average duration of resident stay. And that was a big bet. Nobody in Jacksonville was doing it. Nobody across the country was doing it in our space that I could find, signing long-term leases. But we said, you know what, this just makes too much sense. So we did that. And we started to sign 2- and 3-year leases. Everybody told us it wasn't possible. Everybody told us that you weren't going to get enough residents that would actually buy into that. Some people even told us it was illegal to sign a long-term lease. Like the craziest, ridiculous excuses. But it's been proven to be one of the most impactful decisions that we've made as a business. It's increased returns on investment. And then from a client experience, again, if you don't have a resident leaving every single year, if they stay in there, you know, our average resident stays in there 4.5 years on average across our portfolio of 4,700 homes that we manage now, 4.5 years. Well, your client experience is going to be so much better because you're going to have residents leave every 4.5 years, which you can stomach, right? It's still not fun, but you can stomach that rather than having them leave every 1 year. That's the biggest, greatest thing that we can do for client experience.
Got it. Got it. So Dean Curry puts here in the chat, people probably called you crazy. I think people have been watching that speech, GC. All right, man. So, you know, it's funny. We're going to go into now this like last period, right? These like last 4 years where you go from 40 to 300 and why. But to the point that you're making, right? I kind of told you earlier this morning in our virtual run that I was at this like holding company conference. It was a property manager, and I started asking him about the business, and I just started rattling off like, why don't you do long-term leases? Why don't you, like track renewal rate? Why don't you like track things to ROI for your investors? And he was literally taking notes. I was like, how do you have a 400 property management company and not do this? Because I've been spoiled by the education here, but it dawns on me that, my exposure to this and what y'all have created is the creme de la creme kind of like strategy of all of this. And I didn't realize it, right? Because I've only done this. I'm like a kid that was born rich or something.
It's this bubble phenomenon. Like we talk about this, and our friends who join every single week as Not Your Average Investors on the show, like we become so aware, and we speak the same language, and we make decisions the same way. And that's this wonderful bubble that we have. But we are not normal.
We're not average.
We are not average, right? And then you go into other circles and you realize that, you know what? We're a little bit crazy. We're a little bit weird. We're a little bit different than the masses. And I think that's okay.
I love that, man. Denny Davis asked Pablo, what is a virtual run? Whenever Greg and I don't wake up in the same city on a Tuesday or Thursday, we tend to go for a run while talking on the phone, and we call that a virtual run. Today, it was just a Zoom call because I'm afraid of bears out here. All right, GC, it is now the year 2016. You have built the property management company. You have about 56 rental properties that you're holding in your portfolio. You have sold turnkey rental properties to many an investor at this point. What do you do next?
Well, I think we got the years. We're close on the years, but we're a little off on the years, right? So,
okay.
So, but we'll call it close enough, right? Okay. So we've got from 2014 is really where the lights came on for us. And we said, all right, we had reached certain kind of like milestones in our business. We survived the Great Recession. We found what our special talent was, what we could bring to the world. Like, how could we change the world, right? And this vertically integrated turnkey rental property became that asset class for us. And we proved it to ourselves. We proved it. We've refined it. With property management, we understand it. And it's 2014. And now we've been doing this for 8 years. And it all just sudden just kind of like dawned on us. And we're like, listen, if we've already got this rental property portfolio and we're doing this for everybody else, why don't we supercharge our plan to get to our passive income goal by taking this to the next level for ourselves, by going bigger in our own rental property portfolio? We had just spent, 4-6 years kind of working through the Great Recession and then building this for everybody else. And it's going really well. And we're like, why don't we do this? If we can supercharge our portfolio, if we can go from having 40 rental properties to like 400 rental properties, how much quicker could we get to our own passive income goal? And then secondarily, if we did this, what other ancillary benefits would this have for our business and for our clients, right? How could we be so invested in these neighborhoods that we have our money exactly where we're telling our clients we're putting their money? And how could we be so invested with our own dollars? Because we just know that makes a partner for you perform better, right? So how many other benefits would there be? And we started to look at it and started to piece together all the pieces of the puzzle together. And we're like, this is it, right? This is what we should do. Because all 5 profit centers, we had already knew that all 5 profit centers get better with time. We knew we were going to hold these properties for a long time. Right? I'm not going anywhere. I'm not selling any of my rental properties, right? I'm continuing to hold that rental property portfolio. We're like, if we go bigger here and we go from 40 to let's say 400, we can use all 5 of those profit centers working for us. We can take the gains that we may see over the next 10 years or 20 years and pay down other properties in our portfolio, getting us to our passive income number quicker and to a bigger passive income number. So that's what we started to do.
I love that, man. I love the idea of how do you align yourself more with your clientele, right? Like as a business operator, how do I make it obvious that I'm eating my own dog food, so therefore you can eat some of this too? Is a major strategy. Was it all that strategy, or was there more to that? I mean, you were pulling forward kind of like your own investment plans. Can you just give me a little bit about the thinking of like, was this a retirement play? Was this that strategy play? What were the considerations there?
So to do this, and we can talk about how we did this and how we structured the debt and whatnot. This was a very aggressive plan. Going from 40 to 400, incredibly aggressive, right? There were certain challenges and risks that we had to take that our clients didn't have to take when it came to financing and other things. So we spent a lot of time looking at this, right? Because in order to do this, these were going to be cash flow break-even properties for us, right? So we looked at this and we said, okay, if we're going to take on this risk, if we're going to put all these assets in here, there has to be a big payoff for us, right? At that point, we were a successful business. We had one fastest growing companies for a few years by that point, best places to work. We had some capital. We had some options at that point. And we're like, yeah, we had options, right? And we're like, in order for us to go down this path, it has to be a big payoff for us. And so that big payoff was, this is the right time and the right market to stuff our portfolio with income producing assets, right? With assets that pay off in all 5 profit centers. And if you buy and hold and you give it time, you're going to be able to take those gains from all 5 profit centers and you're going to be able to pay off the other ones. And so the reason why we decided to go so big here was that it wasn't that we were going to accomplish our passive income goals by earning $25 a month in positive cash flow from 400 properties. Like, that wasn't the play. It was like, get these assets in our portfolio, right? Then let's go do what we do. Let's then go do our day job, let's call it, right? Let's make this experience wonderful for clients. Let's sell turnkey properties, all that good stuff, all while our passive income portfolio is working for us. But it's not about that cash flow. It was never about that cash flow for us. These were break even for us. It was about getting them in our portfolio. Over time, all 5 profit centers would work in our favor. And at points, we would be able to refinance those properties, right? Pay off some of them and increase our cash flow that way. But it's contrary to popular demand or belief. It's not about cash flow day one. It's never been about cash flow day one. And it wasn't about cash flow day one for us. And as we start to look at some of the properties that we bought in that year, some years we bought hundreds of properties. And we never said to ourselves, are we earning $25 a month in cash flow or $50 a month in cash flow or $10 a month in cash flow? No, it was about getting the assets in, holding on. Over time, they're going to pay off other ones. And we're going to be at a place that we want to be, 10 years, 20 years down the road.
Yeah. So again, the long-term thinking mentality rears its head as usual here with what you and your partners the way you tend to behave, right? Like, you have one fastest places to work, you're generating cash flow, you have all this clout, you built a machine to withhold this. So you quadruple down on the bet that you've already made because you've learned that the earlier that you put this thing in your back pocket, the sooner it becomes increasing, exponentially increasing options for you down the line, be it increasing cash flow, be it having inventory to offer to clients, be it being able to refinance and go acquire more properties the way that Hervé Francois has famously done so much and turned into 3-for-1s all day long, right?
Exactly. There are so many client stories that we've had either on the show or we've talked about. And all I did is do the same thing, right? I got the assets in the portfolio, let all 5 profit centers work for me, and then I had options. And that's exactly what our clients and our community is doing. And I did it at a bigger scale, but it's exactly what you guys are doing.
Awesome. Talk to me about the conditions of the market during this time, GC. So now we're talking about the macro strategy. Talk to me about the micro decisions. Like we talk a lot about, interest rates. We talk a lot about MOI on the show as predictors of kind of what's happening. Talk to me about that.
Really interesting. So I pulled some of the stats right before the show because I was like, well, what were we looking at compared to what we're looking at right now? It's funny that the first question that one of our friends asked was about a headline about how, the market is crashing, this impending crash and all this good stuff. Get this, guys. All right. So the best leading indicator for short-term pricing is months of inventory. When we were buying this, when we made the decision to go from 40 properties in our portfolio to 400, and we raised millions of dollars of debt to do this, put this capital on the line to do this, MOI was 50% higher than it is today. Actually, I even ran the numbers right here. It was higher than 50%. It's probably 65% higher. MOI in August of 2015 was 3.6 months of inventory.
There you go.
Today, MOI is 2.3 months of inventory. Okay. So it was high. It was more than 50% higher than what it is today.
Yeah. Yet still below the average below the number where it's average appreciation rate. So you saw upside and all these different things, right?
And that's not to say that I think that MOI is going to stay at 2.3 months of inventory, right? Clearly, it's a different set of dynamics that we have today versus where we were in 2015, right? We didn't have two or three straight years of 15 to 25% appreciation in 2015. So I do expect MOI for us to rise, right? It will get closer to equilibrium. But that's just really good for you guys to see. For somebody who's thinking about putting millions of dollars at work for this asset class, because I believed so much in it that I felt like it was going to supercharge me to get to my passive income goals. That was more than 50% higher than the MOI we have. So it's okay for MOI to go up and this asset class is still going to work.
Interesting, man. That's really, really interesting. So what, you also mentioned this idea that you had to do some tricky things to get capital, right? To figure out how to do this. You guys weren't just cash flowing this stuff out of your past property portfolio. Can you tell us a little bit about the moves that you made?
Yeah, so it's really important for us, right? If we're going to go from 440 to 400, this cannot use a lot of JWB capital. That was very important for us. We can't suck the business capital out of our operations to fund our own retirement account purchases, right? We're a fast-growing business, right? So that was never on the table. In order to go from 40 to 400, we had to figure out a way to do this where our assets were going to be break even, but we were going to borrow that money to do that, right? And typically this is pretty easy for JWB. If you think about when we were starting from 2006 to 2010, big reason why that number of properties that we bought was 40 is because that's when we were limited to have 10 finance properties per person, and I have 4 business partners. So we largely got to 40 properties. That was roughly 10 in each of our portfolio, let's call it. And that's really where conventional financing, that's what it was. It's a common limitation even today, right? Fannie Mae loans, conventional financing will say that you can't have a Fannie Mae loan if you have more than 10 finance properties on your credit. So for us, we were going to have to think outside the box. And, I'm inspired by hearing other not your average investors who also think about raising capital to buy properties when they see an opportunity. Like I think about Drew Barnhill, right? I think about the creative strategies that he's employed, right? We were like Drew Barnhill, except we did it slightly different and we did it to a higher degree. For us, one of the financing challenges we were going to run into is after those 10 finance properties, there really wasn't a market in 2013 and 2014 and 2015. It started to develop, but there really wasn't a market for you to go to if you wanted to be an aggregator like we are. An aggregator means that you buy a significant number of properties and you wanted to get long-term debt on them at 30-year rates. There just wasn't a way. It wasn't very, very common. So we actually were one of the very first to find these products. We were kind of like guinea pigs for a lot of these lenders. Today, it is much more common and much, much easier. If anybody here has over 10 finance properties and they want to get really attractive rates, you can do that in any way, shape, or form. Right? It is such an easy obstacle to overcome, but it wasn't in 2015. The way it all shook out is in order for us to accomplish this, the banks were only going to lend to us roughly about 60% LTV. Now, normally banks would lend about 75% to you or 80% to you if you're buying a property and you have less than 10 on your credit. So that's not a problem. Well, now that we're going from 40 to 400, our LTVs are dropping. Another person might say, okay, well, cool. I can't do it. That's not our mentality. It's not how we do it here on the show. All we did is we said, all right, well, if we were to get that long-term debt 60% LTV, so 60% of it covered with other people's money, and we need to get it to about 75% for us to not have our own capital in the deal, then we just need to raise other capital to cover that 15% spread. And we need to do this if we're going to scale up, or otherwise it's going to take too much of JWB's capital. So we went out and we raised private money. And that private money, we paid 10% on that private money. So a lot higher rates than we were hoping for that other long-term debt, but it was a relatively small fraction of the capital stack. And when you ran the numbers, it was cash flow break even. And we said, okay, that's all right. We're going to go ahead. We're going to do this. We raised millions of dollars in private lending. That supplemented the other lending that we had, that 60%. And we were able to get 400 assets into our portfolio starting to work for all those 5 profit centers.
Man, that sounds epic. I mean, that when you tell me that story, right? Like there's a bunch of times on the show, you've said this whole idea of like money shouldn't be the reason, right? Like money's that like, first you should, if the asset's there, like money is the last reason that you can go to, because there's always creative ways to do it. And when I think of like the epic endeavor of raising millions of dollars to close the short range window, to do all these analyses, to then go from 40 to 300 rental properties, that's another kind of example of you guys eating your own dog food, of not using that as an excuse. Is that what's Is that the lesson to be learned there for like an average investor, right? Like for not for an average investor, but for like a
Yeah,
typical member of our community, man. Like, is there a way to do that on a personal level?
man, I see so many examples of this same mindset in a different form in our community, right? Think about when we talk about a home equity line of credit. Okay. So somebody may say, listen, I don't have the capital to buy. I want to buy 3 rental properties with JWB, but I don't have the capital. And, they may say, well, I just don't have the cash right now, but they may be living in California where home prices just went up 20% a year for the last 2 to 3 years, right? They may be sitting on a tremendous amount of equity that's just untapped. They could use a home equity line of credit on their primary residence, on their home in California. Use that capital, probably pay a lot less than 10%, right? Though, I don't know, rates are going up, but let's call it 6% that they're paying on that capital. And they could have that down payment that they need, which they can then use to buy those 3 properties for their Jacksonville portfolio, right? That is something that a lot of people today have the opportunity to do. And as a nation, we are sitting on so much equity, right? So like, there's an example there. I think Drew Barnhill is a great example as well, right? He has figured out how to aggressively use the capital coming from credit cards to be able to use as a down payment, right? And there's a strategy to do that. That's how he's doing. But if you look at the similarities between my example or that home equity line of credit example or Drew's example, it's all the same thing. The reason that we're all doing this is because the value is getting these assets into your portfolio and then holding them so that all 5 profit centers can pay you off over time. And it pays well if you hold on for a long time, right? So the inactivity based on the excuse of not having the capital is not one that I really put much weight in. Right? If you truly want to build a rental property portfolio, guys, I did it when I was 23 and I didn't have any money, right? And I just went to my network and I said, hey, listen, I don't have any money, but I have good credit. Can you put the down payment down for me and I can own the asset, right? You can partner with other people to start building your rental property portfolio. You don't have to have a network of lenders like I had 10 years into the business, right? So if you have a desire, if you think that rental property investing is going to help you accomplish your financial goals, doing it sooner rather than later will get you to your financial goals quicker. But it's not just because you started sooner. It's those years are more financially strong. You have a better return every year because all 5 profit centers are working in your favor earlier, right? Debt pay down is working in your favor earlier. You get tax savings earlier, which helps you have more capital to invest, right? Inflation hedging. We know about that. That starts working earlier. And of course, home price appreciation and net rental income. So yeah, if you look at everything, it comes back to this belief that if I understand this is the asset class for me, doing it sooner, getting them into my portfolio, very similar to you, Pablo, right? Yeah. How does this relate to your mindset before you bought your 3 properties?
I think I'm very much echoing with it, right? Like it was, I needed time to gather data on like whether or not I bought into this thing. That was about a year for me of being this host. And then the moment that I didn't need any more data, I decided to like take away the time element and just get in, right? So I've made every move possible to do it, from putting the thing that I had ready to go in the bucket for long-term investment to cashing out stock and moving it in, to even cashing out my, an old IRA I had to move it into this asset class, right? So like perfectly makes sense to me. I'm trying to figure out what the next level of that I can do, and whether it is, I don't know if I'm ready for private money, like raising private money or not, or I'm probably going to stack some chips and then get back in. But the first part of it, absolutely. Yeah.
Yeah. It's such a cool accomplishment of what you've done over the last 3 years. Now you're on podcast, right? And you're teaching other people about your strategy, which is based on, it's this concept of like, okay, I know a little bit about your portfolio, so hopefully you're okay with me sharing, right? Like you believe in the stock market, you believe in other asset classes, and you believe in real estate. I believe in other asset classes too, and I believe in real estate, but the order of it is different for the way that you and I think versus everybody else. Everybody else tends to put their money in the stock market right off the bat and then try to buy rental properties maybe as they get older. We look at it differently, because if you can switch that and whatever pile of money you were planning on putting in rental properties, if you can do that sooner, that grows. Those 5 profit centers pay you more than if you would have put money in the stock market right off the bat. They get better and better and better. So it's the order that we switch, even though at the end of the day, a diversified portfolio outside of real estate is beautiful. Yeah. But it's that order that's why if you happen to be in your 20s or in your 30s or in your 40s, right? You know, you really are playing with the house's money as far as time, because it doesn't take that long to have a portfolio that accomplishes your passive income goal. It takes some time. It's not overnight, but if you give yourself 10 years or 20 years of holding on to this thing, now you're in control of your time. You can really start to accomplish whatever your why is, which is the reason that you're investing.
Yeah, you're right. It's funny, man. I'm definitely feeling much more comfortable. I told you about this earlier this morning, right? On the podcast, and like having podcast hosts be like, oh my God, I didn't know any of this. And I'm like, you have a scalable real estate investing podcast and you don't understand the 5 profit centers of rental property investing? Like, what world do I live in? But it compared nothing in comparison to like this dude owning the property management company, literally pulling out a notebook and taking notes as I was talking to him on the way to happy hour. That was freaking epic. We got a bunch of Q&A, man. You ready for this?
Love it. Let's do it.
All right, buddy. We got Denny Davis asking, with the massive price increases the last few years, can a person realistically duplicate your success in scale when accounting for debt cost? Wouldn't the debt cost be so much that a person attempting this today would be in severe negative cash flow? And he clarifies that in scale, he means hundreds of properties.
So if you held everything the exact same, then you'd be right, Denny, right? Because baseline cash flows today are lower than they were back in the day, right? We were able to take our debt cost of the supplemental debt, and there was that, you know, whatever, $100 a month or whatever it was going to cost us. And then we were able to create a cash flow break-even property. And that was our model based on where the market is that day or at that time. But I think we need to think beyond, like, if your question is it possible to duplicate what we did and to have them be cash flow break even and to go massive in this? Absolutely. The beautiful thing about raising debt or about partnerships is that you set the terms. If you don't have the ability to pay monthly cash flow because it would take you negative, who's that up to? It's up to you. When you go and you raise that private debt, you can say, listen, I'm not going to pay you for monthly payments. And let's come up with an attractive process. I can just tell you, I've done debt like that many times, especially when we were starting, right? We were a young company and I didn't want to pay monthly debt. We've raised hundreds of millions of dollars without paying monthly payments on debt, right? So, you know, I can't say that the exact way that I did it in 2015, if you follow that exact process, you're right, Denny, it would be negative cash flow. But let's open up the mind a little bit more, right? You are in control of putting this structure together. And I'm confident if anybody wanted to take on the risk and put in the work to do what we did, they could do it.
Yeah, that was the other thing that I learned at this Holdco conference, man. Like, businesses are so hard to operate, right? And yet you see kind of like real estate's a formula, right? Like there's all these different variables when you are running a service business, which a lot of these guys had, or an e-commerce business that all of these guys had. And it's a lot of variables. It feels to me that real estate out of all these businesses seem to be the most formulaic, like if you structure it this way, it's going to succeed. If you are thinking about it this way, it will succeed. And that was a big takeaway, which kind of reminds me of what you're saying right now.
Well, I think so. And I think it's easier to plan for how you're going to be successful in real estate and rental properties at the end of the day, because the lending is so tried and true, right? Banks love lending on real estate, rental properties, primary residences. Like this is a $1 trillion industry. Yep. Wall Street loves lending, right? That's what mortgage-backed securities are. Investors invest on the back end because they love the fact that people generally make their house payments. And so when you have that kind of structure built into the financing side of this, it allows you as an investor to say, okay, cool. I don't have to recreate the wheel every single time. I might just have to, if it doesn't work at 75% LTV because you're trying to go from 40 to 400, you just might have to figure out a spread of that 15% of debt that you have to raise. And then how could I create a structure that works for somebody that I'm going to borrow money from, but that doesn't include monthly payments to them? Can you still do that? Yeah, absolutely. I've raised millions of dollars that way. And I did it when I was like 23, 24, 25, when I didn't have a track record, right? So it's nice when you work with an asset class that is so generally accepted in the financing world. It's harder. You have to recreate and figure more things out when you're doing something that's kind of uncharted.
Yeah, makes sense. All right. Bill Shields, also known as Guillermo Shields, Guillermo Escudos, Escudos means shields, for the record, Greg. I don't know if you got that in your Spanish classes.
That's chapter 8. I'm only on chapter 7.
Yeah, he asks, if you use an equity loan or credit to purchase properties, how do you pay those loans back when there is little cash flow?
I love this, Bill. You gave me a perfect segue to a point that I wanted to make, which was, all right, if you go back to like, why did we make this big bet to go from 40 to 400 properties? Our big bet was that over time, we would be able to take the gains from those properties, and it would actually get us to our passive income goal quicker and pay those properties off. Well, that wasn't the only thing that we were doing, right? It's been important for us to, of course, insulate our business, insulate our cash flow. I believe in smart debt, but I definitely do not believe in over leveraging. And we always looked at, our overall portfolio and said, over time, let's bring our debt ratio down. Okay. So I'm talking about those 400 properties. If you think when we bought them, let's just say that we were leveraged at about 75% loan to value. Well, over time, as our business is more successful, right, we should start to see those leverage amounts go down, not just because we're making the payments every single month or our residents are making the payments. So what we would do every single year in business plannings is we looked and we said, okay, a certain amount of our capital that we earn through the activities of JWB Real Estate Capital, we're going to pay down our properties. We're going to get our leverage down. So, and this is exactly like our Not Your Average Investor community does, right? We talk about how do we decide what is the right strategy for debt pay down? Well, this is what we did. And for us, it was a certain amount of, profits we would make in the business. And that went to pay down part of our rental property portfolio. So it's on our cash flow doc. I look at it every Wednesday, and there's a certain line item that, X number of thousands of dollars every single week, that's going to pay down this, that's going to pay down this. And it's been really cool. Actually, we accomplished our pay down goal last year.
Awesome, man. I would love to see a show about that. All right. We also got one of our favorite community members here, all the way from France, Anonymous Attendé, asked the question, by having tenants sign 3-year leases, how do you capture the upside of rapidly increasing rents?
Great question, Anonymous Attendé. A very common question. So, many people aren't, I think big picture, when we're talking about long-term leases, we have to kind of set the standard. If you sign a long-term lease and you get no rent increases, but you save not having $5,000 to $6,000 or $7,000 of costs from maintenance and vacancy costs and tenant placement fees, if you just get no rent increases and you run that out for a 5-year span or a 10-year span, you actually win by signing 3-year leases and having residents stay a long time. And so I just point this out because when you talk about getting rent increases, you should think of that as playing with the house's money. Even if you don't get them, you are going to make more money when you think about the lack of maintenance and vacancy costs and tenant placement fees that you will pay. All right. Now, with that being said, we want to do as well as we can for you and for our clients. And we want to take advantage of rent increase opportunities. So we still get them. We sign long-term leases and we get rent increases. But we also give an incentive for a resident to want to stay with us. It has to be a win across the board. So the way that we do this is if you sign a 2-year lease with JWB, your rent is going up somewhere between 4 to 6% in the second year. Just right off the bat. You just know that. So you're getting 4 to 6% rent increases. Now, historically, Jacksonville's rent increases year over year is actually 3.3% per year. So we actually get much higher rent increases and our residents are prepared for it. It helps right now because rents have gone up so much, right? But 4 to 6% for you is fantastic, right? Now, if somebody signs a 3-year lease, we want to give them an incentive to sign a 3-year lease because that's going to limit your maintenance and vacancy costs. We keep the 3rd year of rent the same, meaning it went up 4 to 6% from year one to year 2. If you sign a 3-year lease with JWB, your 3rd year is going to stay the same. You get a break for signing long-term because we all win, right? The resident wins. You win because they sign a 3-year lease. And even if you didn't get any rent increases, it's a better thing for you than signing 1-year leases. You know, and JWB wins, of course, because we have happy clients and happy residents. So that's how we do it. We give them a little bit of an incentive to sign that 3-year lease. And on the second year, if people just continue to sign 2nd-year leases or 2-year leases, they'll continue to see those 4% increases year over year. And I should also point out that when we go to renew residents, regardless of whatever lease they sign right off the bat, when we go to renew them, they always get brought up to market rent. So in that 3rd year, if somebody signed a 3-year lease, that's just a 1-year kind of bonus of not having rent increases. That next year, they're definitely going up to market rent.
There you go. That proactively answered Miguel Angel Sanudo's question of the difference between rate increase for 3-year lease versus 2-year lease. Last question, GC, before we get out of here, the ringmaster himself has a little request. He's asked, can you give us some lenders who will do aggregate lending? If you'd rather do that via email, that's fine. Is that something that they can go to the portfolio manager for?
100%. Happy to do that for you, Drew. Just reach out to your portfolio manager and they'll take care of you, bud.
GC, what is, before we wrap up this epic multi-part saga of the building of a 300 property rental portfolio, what's the overall lesson here, man? What can we take right now, today that is, you know, actionable, learnable from your experience in doing this?
If I think about my experience here and my success with this, it all started with thinking about the end in mind. It started with understanding what is my why. For me, my why is that I wanted to control my time. I started young and I didn't have a family, but I envisioned having a family and I wanted to be able to control my time so that I could be there and do what was important for my family in 10 years after I started to invest, or 15 years or 20 years, whatever it is for you. I think, you know, establishing that why is really important. Then going from understanding that why to putting a plan in place. That's where most investors don't do. Most investors don't do it in any asset class, although almost nobody does it in rental property investing. But you can actually take that why, and my team can help you put a plan together. And this is what I did. We started to think about the end in mind. We said, okay, we wanted to have this goal accomplished from a passive income number. Then we just break that down into a number of properties. For us, it happened to be about 400. I don't know what the right number is for you, but there's a number. And then we go about executing on that plan. And so I think that while that may sound simple, that isn't typically done in the rental property investing world. And that's something that's sorely missing. It's something my team loves to help people do. So that's a big takeaway. Understand why you're doing this, then work with a professional to help you build a plan. There are going to be challenges that come up and we'll figure out how to execute in those challenges, right? It's not easy to go from 40 to 400. We've seen all those challenges. We can certainly help you. And then the last final point that I would share is once you understand that rental properties need to be in your portfolio, getting them, front loading your portfolio, getting them in as soon as possible is incredibly powerful for you. It is much better for you to do that right off the bat, front load them, than to buy in lockstep with other asset classes later on. And the reason is because real estate pays you 5 ways, and all of those ways get better with time. The other asset classes don't pay you 5 ways, and they don't get better with time. So if you have that, you know it's going to be in your portfolio, front loading. That's what I did. I did it to a large scale, but it's the same thing I would recommend to others as well.
Love it, man. Rental property investing, the fine wine of investing. I'm into it, man. I'm really, really into it. Thank you, GC. A lot of great reviews here on this show today. On Thursday, we're doing something a little bit different, as we tend to do out here on the Not Your Average Investor show. We've had guest investors. We've had fan appreciation shows. We're having a team takeover. You're going to meet a bunch of the teammates from JWB. We're calling it How You Build a Talent Destination as a Real Estate Company, or how a real estate company becomes a talent destination. You're going to meet a bunch of the folks behind the scenes, and we're going to just, give you access to what makes them want to work in real estate, what they have learned that you can take away from, and you're going to meet a bunch of the team, which is the driving force behind the success here at JWB and the client experience that GC talks so endearingly about. And with that, I want to thank you, community, for being here. We had over 40 people today. We never take it for granted. This is the middle of a workday, right? Like, the fact that you spend time with us never goes unnoticed, and we are insanely grateful about it. And we're also super grateful for you, friend in podcast, in YouTube, that has been listening. We'd love to have you a little closer to the hearth here of the family home. Step next to the fire. It's nice and warm. I'm schwitzing over here. Go to nyais.com. Show up one of these days. Hang out with us. Make a friend in the chat. Meet Madison the Magnificent. It's worth it. And with that, GC, I'm going to give you last words, buddy.
This has been a special trip down memory lane these last few shows. Thank you guys for the opportunity to go back and live some of those moments again. They weren't always fun moments. I'll tell you, there was a lot of fear in some of those moments, and there was a lot of lessons in some of those moments as well. But being able to share the good, the bad, the ugly with a group of friends and supporters has been really, really impactful for me. So thank you all for the opportunity to do that, and hopefully we're all able to learn a little something, and hopefully it can help you in your portfolio. Thanks, you guys, for being here. We appreciate you.
All right. We will see you on the next show. And until then, remember, if you want to grow a portfolio of 300 rental income properties, you just definitely cannot be average. See ya.